Hey guys, John with TRD Trader here. So I'm going to go over my review of the performance for the week. Now there's going to be two performances. There's going to be the performance of my portfolio and then the performance of my calls. Unfortunately, because I tried to get into my trades a little later on Monday, I was not able to get in on the calls that I had called. Now if I had done a limit sell order, I probably could have gotten in on the trades like Monday afternoon or Tuesday afternoon when the stock prices came back down to my strike price, but I was impatient, so I didn't do the sell limit order. So if I had, I would have gotten in at my strike prices that I wanted. I didn't. I got in at a little higher point, so now the performance, there's going to be a difference between the performance of my portfolio and the performance of the calls that I had suggested. So for right now, I'm just going to go over the calls that I had suggested. So there's going to be generally two buckets of calls that I suggested. Some of the stocks went way up. Other stocks, they retraced back a little. So that's what's leading to the two groups. There's going to be one group where the calls, we sold puts, and the puts were not enacted because the stock price ended at the end of the week above the strike price. So because the market closed with the stock price above the strike price, no one's going to force you to buy stock for less than what they can sell it on the market. So those options will expire worthless and you'll keep all of the premium. And then there's going to be some stocks where the stock price fell below the strike price, and because you did sell a contract, you're going to be forced to buy the stock, and your basis is going to be whatever the strike price was less the premium you earned. But we'll go over that in a second. So let's just go over first the calls where you didn't have to buy the stock if you followed these plays. So let me go ahead and filter for the NAs. So these are the stocks that I had called where the strike price was still below the market price at the end of the week. And so we had Marathon. I had called strike prices of 26.50 and 25.50. They didn't get enacted on because Marathon ended at 30.29. I had MVIS at 15.50. Didn't get enacted on because the strike price was 19.19. Riot at 30.50 and 32 didn't get acted on because Riot ended at 36.23, and Six Flags at 42.50 didn't get acted on because Six Flags ended at 43.69. So because the stock price ended, the market ended with the stock price above the strike price. No, these puts are not going to get enforced because no one wants to sell their stock for less than what they can sell it in the market. So if you had gotten in on these plays, you would have got anywhere between a 2.5% or a 2.25% return all the way up to 4% return. Now these are the plays where the puts didn't get acted on. Let's go to the plays where the puts did get acted on, and even there we're still not too in a bad shape if you got in on these plays. Let's filter out the not profitable. We'll go with the profitable ones. So these are the ones where the stock price ended below your strike price, but if you subtract out the premium you earned, you can still sell it at a profit the minute the market opens on Tuesday. So for example, Halliburton, the stock price ended at $23.78, and I called a $24 strike price. But if you'd sold the 24 put, you would have got, You would have got 50 cents of premium. So your basis is 24 minus 50 cents. Your basis is 23.50. So you can actually sell it for a 28-cent profit. That is a 1% return over the week and 0.25% return per day. So even with this Halliburton call, you're still making 1% a week. With MVIS, I called a strike price of 16. The stock ended at $15.99, so you're probably going to get forced to buy it. But your basis is $15.46 because you sold a $16 put, but you were paid 54 cents to sell it. So therefore your basis is, let's round it up, $15.50. So you're making 50 cents profit when you sell it Tuesday morning, and that's still a 3% return for the week. And the last one, Workhorse 1450, it ended at 1417. So if the stock ended at 1417 and you sold a strike price of 1450, you're going to get forced to buy it at 1450. However, you were paid a premium of 39 cents to enter in the contract. So your basis is actually 1411. 1417 minus 1411, you're going to make a 6-cent per share profit, or a 0.5% of return for the week. These are the ones where, even though you're going to get forced to buy, you can immediately liquidate the investment for somewhat of a profit, and you can go back to right selling puts for 1 to 2% a week. Now let's go over the ones where it's not immediately profitable to resell, and that's going to be not profitable to sell now, sell calls until you make it. So these are the calls where not only did you get forced to buy the stock, but you can't immediately sell it without having a small loss. It's whether up to you if you were in on these plays, whether you want to sell for a loss and go back to earning 1 to 2%. I like to go, when I'm in this kind of a position, I like to turn around and sell calls until I am in a position to profit. So for example, we had a strike price of $40 on Blink. The actual ending price for the market was $37.38, and we also had a strike price of $41.50 for Blink. The ending market price was $37.38. So your basis is $39.20 and $40.10. So you're going to be in a loss position. So what I would do is I would turn around and I would sell calls for $37.50, which is above your basis of $37.38, and you're going to make $1.14 of premium per share to sell that call, which is a 3% return per week. For this one, because your basis is in the 40s, I'd rather sell a $41 call, premium of 26 cents, return of almost 1% a week. So you see, even with these, like, we're not doing too bad, even though we now own the stock and we can't immediately sell it. We can turn around and sell calls for anywhere from slightly less than 1% return all the way up to 5% return. So Fubo, it ended at 30.06. If you'd follow these plays, your basis would have been, you would have had a strike price of $32 and $33. So you're going to get forced to buy the stock. Your basis is $31.28 and $31.87 after your premium. So you can turn around and sell calls, 50 cents per share, a 1.5% return. And lastly, Workhorse, it ended at $14.17. Your strike price was $15. Your premium was 62 cents. So your basis after you get forced to buy it is $14.38. So you're going to be in a loss if you sell immediately. You can turn around and sell $14.50 calls, which is above your basis here, right? You want to aim for calls, strike prices that are above your basis. But when you sell a $14.50 call, you're going to get 72 cents in premium, and you're going to get a return of 5% per week. So you can see, even though when I judge floors a little, not as accurately, and we get forced to buy the stock, either there's instances where we can turn around and sell it for a small profit, or we can turn around and sell calls until we can sell it for a profit. So just something to consider for this week. So these were the performances of my calls. But as I said, I didn't adhere to these because I was impatient. I just wanted to get into the market. I probably should have put limit sell orders, and I probably will in the future for my options. So with that in mind, here's the actual performance of my portfolio. I started the week with 27,416. Because I was impatient and I got higher strike prices, I'm going to have a higher basis, and I'm not going to earn as much with calls. So my portfolio ended $400 less. So I had my portfolio retraced 1.5%. So if you see, the actual total return over the 2 weeks is going to be almost 3%, or an average of 1.5% per week. So I did pretty good last week. I didn't do as good this week. I would have done better if I put sell limit orders on my my put contracts. If I had done that, I think I would have done a lot better, but I didn't. So I had higher strike prices, way higher than I had, either the same strike price and lower premium, or higher strike price and same premium than the calls I had called. So because of that, I'm in a slight loss position, but even not that big. I'm still $700 better than my beginning of last week. So I'm still doing good, not as good as I had hoped for, but that's just a learning lesson for me to put sell orders, limit orders on my purchase, on my option sells, so that because I noticed, even though I had sold my options because the stock had gone way up and I couldn't get in at the price level I wanted, I sold up here, and then the stock started rebounding, or didn't rebound, it fell a little bit. And if I had waited Tuesday or Wednesday afternoon, I probably could have gotten in on the calls I had anticipated Tuesday or Wednesday, and then I wouldn't have as much of a loss, or I'd even have more of a gain. So that's just a lesson, not to be impatient, but to put your limit orders and stick to your calls. But even when I didn't stick to my calls, I still did pretty good. I didn't lose out all that much money, and I'm gonna turn around and sell calls tomorrow or next week and I won't be making 2 to 3% return on the calls that I sell. I'll be making probably 0.5% to 1% return, and but that's life. So I hope you're following these calls, and I hope if you got in on these calls, you made some money. Thank you for watching. I hope you guys have a great day.